Good afternoon, everyone. This is Brad Matheny. I just got the webinar started. Let's wait for everyone to attend. We are going to try to go over a training session today covering the general markets. Been very interesting to see a number of big market rotations over this week. In fact, I posted this chart earlier on Twitter. Let me come over here. And this is not the chart. Let me come in here. Well, we'll get to the chart over here. I'll open up a new one. So, wait for it to load. Took a while. There we go. So this is a chart I'm working on my other system. I find it incredibly interesting to see how the markets are moving within this channel and within this price range. So you can see that these Fibonacci price structures that I went over related to highs and lows and how I had predicted. Let me get rid of this real quick so we don't get interrupted via emails. The Fibonacci price structure continued to rotate up until this area. Then we got this big bout of volatility establishing these breakout ranges. And you can see I've highlighted them up here with these bars. And we've come back down and double bottomed here. Actually, a little, double bottoms, understand that double bottoms do not have to be exact. They can be a few ticks away. And depending on how you want to understand double tops and double bottoms, I mean, they could be as far as, 0.2, 0.15, 0.25, depending on the actual market activity. Now, if you're down on a 1 or a 2 minute chart and you're looking for a double bottom, ideally you want to be probably within 3 or 4, maybe 5 ticks. If you're sitting on here on a 2-hour chart like I am, and you're looking at this as a double bottom, yeah, I'm pretty much counting this as a double bottom, simply because we have very solid double bottoming, very close to these lows, trying to highlight this low here versus this low here. And in reality, I'm going up to the close of this bar, this black bar right there, and referencing that as support. Now, Google Chrome is going to give me all kinds of notices. Got to clean these things up before I do my webinar. Okay, Bernice, hi, I see you. Let me know if you can hear me okay. And like I said, this is only the second webinar that I've done. I'm trying to make this very functional for members. Use chat, Bernice, if you can hear me. If you have any specific questions, let me know. Otherwise, I'm going to go over the markets in general. So last week, I had an interesting phone call with a gentleman back east. I won't use your name unless you show up in the webinar again. He is a fund manager. He's got quite a bit of money under management, been doing this for quite a long time. And the essence of our conversation was whether or not the US markets are going to enter a hard landing or whether they're going to enter a soft landing. So let me come back over here and shrink this out, move this to weekly. And I want you to try to understand my thinking related to a hard landing versus a soft landing is that it is going to be dependent on whether the US is capable of navigating global market risk and whether the US is prone to some sort of a downward or credit event type catalyst. Now, the debt ceiling limit coming up near June 1st, possibly a little earlier, is something we have to be aware of and could prompt some kind of a downside reality for the markets. I don't believe personally that anybody in Washington, D.C. wants to push this beyond capable limits. meaning there may be some sort of a shutdown for a period while everybody scrambles and tries to get things together, and then it'll be resolved. We've seen one or two of those before, I believe. One that I can remember where the government entered a shutdown while everything negotiated for about 2 weeks. This was back, I believe, in the Obama administration. But again, nobody's going to want to shut down global economics, and there's going to be some resolution to it. But the real catalyst for some massive hard landing, you ask yourself, is it the Fed? Is it the Fed breaking things? Well, again, look at this data here. So I highlighted this to the gentleman I was speaking with the other day, and I just want you guys to be aware of my thinking as we move forward. So we had this really incredible rally phase. Actually, it doesn't. I don't know if this goes back here. Let me come over here because I know one symbol that does go all the way back is the Dow Jones. So what I want to do is highlight all of this. Okay. We're going to come into this area and let it load. So we have this incredible rally phase. Remember, this is where the US ended the gold standard, was really in 71, 72. So I'll mark it right there, 72. I'll make it kind of a gold color. Okay. This was where credit started to really expand. This was also a block of extreme, when you consider it, this was a block of extreme all the way up into 81, 82. I'll carry it to here, of extreme inflation, very similar to what we're having right now. Okay, we had high inflation, we had the oil crisis, the Iran oil crisis. We had, there was still growth in the economy. When you consider, if you add here, I don't think we have data going all the way back, but there was still growth in the economy. That we were still growing at a period of time. Then we moved into the late 80s, and you have to understand that from this time frame, we had a growth in assets. I'll get this trend line roughly from this low all the way up to the top in 2000, in 1999, 2000. Was a 1,443% rally. So understand that we had an incredible wealth creation from the 80s all the way up to 2000. We had a massive wealth creation take place. This was a huge amount of money where the people that had purchased homes back in this area, let's call it roughly in this area, where they had acquired assets, they were up in there, let's call them 60s or 70s. They were into retirement. This was a massive bubble of wealth that was created. These people they went from having 40, 50, 60, $100,000 in their account up to $500,000, $1 million into their retirement account. And this wealth bubble, I'll type this in right here. This wealth bubble allowed the individuals withstanding this to ride it out. So this was the 2000 to 2002 roughly bottom right in here. Change this to red. And this was the 2008 to 2010 roughly bottom. Try to get as close as I can. And this was the recovery rally that took place between 2002 and 2008-9. Now, during this time, the Fed I'll highlight it over here. The Fed between 2005 roughly and 2007 started raising rates very aggressively. And this is something I will highlight here and highlight here. But understand that the new wealth that was created in this area, so this is a period of new wealth from the 90s all the way to here. This is new wealth. And this type of wealth was at risk. So if you bought in down here, or down here, or down here, or you were in your 50s, 60s, back over here, 70s, 80s, and went through your retirement. By the time you went from 78 to 88, you might have gone from 60 to 70. And then from 88 to 98, you went from 70 to 80, and then maybe survived out over here. You didn't see so much of a destruction of wealth. But if you were buying in this area, in this bubble area, 96, 97, 98, you went through a period of time that was an extreme contraction. And what I'm trying to point out here is this wealth bubble that was created represented basically a 13-year time frame before there was any real growth. Okay, so this was a bubble that took place where, let's call it 60-70% of those from back over here, those in their 40s, 50s, 60s acquiring wealth, were able to ride this out. But those that were, and I'm going to highlight this in what I'll call a danger zone. So this is kind of a danger zone here. And this is an opportunity zone here. Sorry, let me get this. This is an opportunity zone here. So if you were in this opportunity zone, I'll make this green. You were able to ride this out and ride out this contraction without too much difficulty. Whereas if you were in this danger zone here, this blue area, which maybe I'll make it a yellow danger zone, you then had a period of time here which was very destructive to your portfolio. Not only maybe did you lose your house, lose your job, lose 40, 50% of your wealth, because depending on where you got in here, depending on how deeply and how active you were through this, you went through approximately from 99 to 2013, which is 13, 14 years of very moderate price appreciation. If you got into this area to this area, you witnessed a appreciation of only 42%, if you were lucky and you held out the entire thing. But now what I was talking to this gentleman, this wealth manager, about was this appreciation. Now we've gone through this next wealth bubble, blown this, drag this up here. We've gone through another massive wealth bubble. Hypothetically, let's pick a low from here to here. We've gone up another 270, I think it was 274%. Remember, I'm pointing right over to this area here. 274%, a huge increase over the last 8, 10, 12 years. And the argument that I had was that at this particular point in time, when we were in this area right here, okay, the Fed was raising rates aggressively. I want to make this point. That was raising rates aggressively at a point in time very late in a recovery cycle. So understand that we had not recovered very high. We had not moved very much above these areas here. And this was creating a massive wealth conflict. In other words, the Fed was attempting to raise rates into this hyperinflated housing market where the assets had only appreciated from this level here, from this high right here to this high right here, 18, roughly 20%. And this is the Dow Jones, remember, not the S&P or the NASDAQ. So you had a scenario here where the Fed was raising rates aggressively after a massive wealth bubble, after this first collapse, after a bit of a recovery, into a stagflation market. So now you need to understand that new generations of wealth start about every 20 years. What I'm going to do is I will use a cycle. So we see if I can do it this way. So if I can move this as tight as I can get it. So I will move it back here, come back here. Let's just start in the 70s. If you're old enough to remember, I'm close to 60, so I'm going to pick a 20 year, so 70s to 90s. So hypothetically, ladies and gentlemen, these are every year there's a new class of people, new graduation class of college or high school that enter the workforce. And generally, it's about a 15 to 20-year cycle, the way I look at it. Okay. And what this means is that the kids that are generating high school right now will take 20 years to reach 38, which will put them, early young adult. Will have acquired some wealth. They'll be putting money into the markets, probably have a home, maybe, probably have a family, maybe. And they're moving into the next phase of their life, which is 38 to 58. And then at that point, they start to move into the later stages of life, which is the 58 to 78 time frame. And then at that point, they move into the old age, the 78 to maybe 98 type of time frame. So you've got this window of opportunity. Those that were born in the 60s or the 70s had this window here of the first growth of wealth. Then they had the second growth of wealth, which, remember, represented a pretty good wealth creation. And then from here to here, about 262% if they were participating. Then they had this secondary wealth creation, which is going to come back out over here to 2030. But the reality is that if you were in this scenario, if you were living through this bubble, if you were born in the 90s and reached from this point and reached the area where you could start attributing and contributing into your 401k in this area, if you got in early through the Bitcoin rally or the stock market rally, you've seen this incredible wealth bubble, which is why I believe, again, this pullback that we've seen, and I'm going to highlight something very interesting. If I can get my mouse, oh, there's one right here. Okay. Clone. You see that range, ladies and gentlemen? We have already seen on the Dow Jones essentially a pullback equal to the 2008 to 2010 pullback. So this range equals this range right there from here to here. I'll drag this over, which is why I believe if the US is capable of navigating foreign market risk, I believe foreign market risk is the most dangerous. Personally, foreign market risk is the most dangerous for the global markets over the next 7 to 10 years. US market risk, I believe, will be relatively contained. I think we will still have our issues. There will still be asset price devaluation. There will be consolidation. I believe that after the COVID bubble, and I will highlight the COVID bubble with a bright range here. See if I can do this. So we'll go from here to here, up to here. This is the COVID bubble. I don't know what color to make this. We'll make this a blue bubble. So this is the COVID hyperinflation. This was the Fed prompted rally phase after the elections. This was the 2015-16 pre-election timeframe. This was the rally phase out of it with President Trump and his new tax policies. This was the corrections in 2018, which was a big correction with the Fed trying to raise rates. Then we had the COVID collapse. Then we have the zero interest policy, the incentives throughout the world to keep the economy rolling. And we have this big bubble phase. This big block of wealth, this basically from 2015 all the way up, this big block of wealth, if you take a look at it, is bigger than at any time really in history. So you come back here and you can say, all right, from here to here, how much is that block of wealth equal to? Well, it's equal to all of history. Okay. It's bigger than the Dow Jones historical data goes back, literally, because when you look at it, it goes down to a negative 4,306. So this big rally phase that we saw right up here is a huge, big wealth gap. This is I don't want to call it a wealth gap. This is a wealth, um, let's call it resource. And what we have, if I can spell resource right, what we have right here is that this wealth resource, and I'm going to make this green, is now going to play out as a resource for the unwinding of assets going forward. So we have this big wealth resource. Really, it goes back deeper, back into this area, because this wealth bubble gets compounded into the wealth resource that's building through this area. But I'm going to leave it right to here. It's just simply for transparency. So ultimately, if we have some sort of a breakdown, my first guess would be that this 2015 high level, which targets the COVID lows right here, would be our critical support level. Secondarily, I believe this apex level, you can see that we have an expanding wedge formation across here and across here. I'm going to keep it fairly clear. This expanding wedge, if we go to the apex of that wedge, which is the middle level where these two lines would eventually meet, would put us right about here. This level would be a secondary level for support. And remember, this would essentially be, you want to see where this apex is. We come across here. And we come across here. So somewhere about where, oops. Somewhere about here. That's the apex of the expanding wedge. Actually, it can move up slightly, but you get it. That's the apex of the expanding wedge. So this becomes a support level, and this becomes a support level. And now we have this intermediate low off of the October lows, or August, I believe it was, back from 2022, which becomes a secondary support level. Okay, so now let's have a little fun with this. Okay, let's play around with some technicals and see how this plays out. So what I'm going to do is I'm going to pick the low on the Dow Jones back over here, all the way up to the high back over here. And now we're going to start looking for pullbacks. So we don't have any major pullback aligning with this area yet, but we're sticking with the basics. These are what I call the basic Fibonacci levels. So we have the 382, the 0.50, the 618, the 764, and the 0.97. A lot of people don't understand this 0.97, but I want you to understand that this is a very important level. This is where double bottomings and deeper retracements pull back off of. So let's come in here and add we'll add this, say 0.25. And let's see if that, yeah, that pulls pretty close. So we'll leave that. So here's our 25% pullback. And that aligns very closely with this Fibonacci, or this recent pullback. What we have here, ladies and gentlemen, is what I believe, again, because this downside move here is equal to the downside move of this global financial collapse, I believe this is the initial and possibly final move downward through this initial revaluation phase of the market. What I believe is going to happen is what I've shown you on many, many other charts, and I've got to do this by drawing a couple lines out in the future. So let me show you what this is. So I'm going to try to show you here by pointing out that I believe we will reach a base bottom in July, August, September, roughly here. I believe that we will reach a new high in early 2024. Oh, actually, I'm moving. This is July, August 2023, new high in April 2024, potential new low in July, August 2024. and then a potential breakaway rally in early 2025. So now we come back over here. The reason I drew these vertical lines is to show you what I believe is going to happen. The unwinding of assets is going to continue to play out over the next 3 to 5 years. We will start to see some upward movement, but it's going to be very biased around the topping pattern, which is likely to occur somewhere over in here, reaching some sort of a base here, rallying up to a high here, reaching some sort of a base here, rallying up to a high here, and then eventually stalling and moving back into the upside here. So this is the scenario that we have for the markets. Oops. Going forward as this wealth bubble consolidates. The markets are going to be struggling. Real estate's going to struggle. The Fed's going to keep interest rates higher. Traders need to understand that we are just like we saw between 2000 and 2008. We're very likely going to see about 3.5 years of consolidation, maybe in a trend similar to about this range. Okay, a little bit wider than what we had seen in 2008 to 2010 correction. But eventually, out here in 2025 and 2026, we're going to see some kind of a rallying phase. And this is because we have a massive election taking place in 2024, right there, highlighted as blue. We have an election of a new president taking place right over here. And what's going to take place at this point is new policy, probably new plans, new expectations, maybe new global efforts around policy changes. And it's basically going to take about 2.5 to 3.5 years for this excessive policy, this wealth bubble to consolidate. Now, understand that when we take a look at this consolidation, we need to remember that we have gone through a massive wealth bubble. How do we control these wealth bubbles? Well, these wealth bubbles take an excessive amount of time. Look at how much time it took over here for the wealth bubble that was created over here to unwind. And you can see we reached this topping formation, consolidated, then bounced up a little bit. But still, if I were to include all of that throughout this contraction and rotation phase, this took from 1999 to 2006. It basically took 7 years. Okay, that same type of setup, but now I'm expecting half of that, only half of this wealth. Now, why? Why is it speeding up? Why are the cycle events speeding up? I believe the cycle events are speeding up simply because of the amount of wealth that's been created. I believe that everything is moving into a hypercycle phase, reaching an apex that I believe is going to come into play over in this area. Actually, it's going to be way up here, so be prepared. It's going to be over here sometime between late 2029 and 2032, 33 roughly. So we are going to be probably reaching some sort of an apex peak right up over here, which means a major global market peak in this area, where a pullback again of potentially 30 to 60% is likely. So we would have to take a look at something. And again, I'm going to take a look here. That's 78%. So when I say 30%, we could move back down into these areas. Or when I say 60%, we could move back down into these areas, which is the COVID low. So understand, this is how I see the big broader markets playing out. Okay. So now gold and silver, I've already highlighted this. Let me see if I have a gold chart. I think I have a gold chart here. Yes, I do. Gold and silver are moving, as I've shown in my videos, into what I call an early stage setup phase. This is a weekly gold chart. You can see I've highlighted the setup phase here. indicating, and I'll move this back out, indicating that we're going to move into what's called the breakaway phase next. So we're looking at potentially coming back down into this red support area, this area here, or this area here, 1979 or lower, or in this case, 2010 or lower. And what this is going to do is give us the ability to buy back into gold and silver and to present a real opportunity for the next upside move. The next upside move is going to put gold and silver up around 2023 to 2230 to 2250. Then we're going to see a pullback, and we're going to see some consolidation back in this lower range, moving into a breakaway phase, and likely attempting then around 2024, around the election, moving November 2024 into a big, broad, upward phase. Now, this is going to catch a lot of traders off guard. This is going to basically catch a lot of people thinking that gold is rallying excessively into the next big market phase. But in reality, gold is going to set up into a broad extended consolidation out until we get some real crisis event, which is not going to take place until 2027, 28, 29. So understand that we're really looking at some real consolidation in gold after we get past this breakaway phase. We won't start the expansion phase until we get back over here in 2027, 2028. Okay. Yeah, I know. This is my second webinar. I have 0 participants right now. I only had 2 show up. I don't expect on the first couple ones to have too many, but so now what do I do? So my research, I've been doing proprietary research for over 30 years. I've been building trading systems for over 30 years. I've been developing code for over 35 years. I specialize in adaptive modeling and predictive modeling software and automated trading systems. The reality is, ladies and gentlemen, I have a wealth of information that helps me identify what's going on in the markets and to see how things are trading. What I try to do is to deliver through my expert growth membership, which is all detailed right here, what you get: critical, actionable, reliable systems to give you what you need in terms of real data. Okay, this is not, I guess it's doing this or I guess it's doing that. Yeah, when I present to you a chart like this, hypothetically, or this, sorry, where is it? Dow Jones, SPY, not that one, not that one, not that one. I don't know where it went. Oh, it was the gold one. So when I present to you a chart like this, estimating where things are going to go, this is really a guess. This is really my using my best knowledge and insight to tell you what I believe is going to happen going out 2, 3, 5 years into the future. When we come back over here to the SPY, okay, and we look at this is a 4-hour chart, huge, massive rally. And I tell you what's actually taking place, and I give you my research on an intraday basis. The idea here, ladies and gentlemen, is I am trying to provide to you the best resource I can for you to make decisions, for you to trade efficiently, for you to be aware of the biasing and the market dynamics at play in the market. And I'm doing it every week and every day to try to help you stay aware of what's actually happening. I watch a lot of people on Twitter and other places, try to tell you that they've got this or they've got that. I watch all these shorters bet the market's going to go down over the last 3 or 4 weeks, or literally all the way up here, and just betting that the market is going to collapse, like I talked about it earlier on in this webinar. I had a conversation with a gentleman who manages millions of dollars, and we had a very great discussion about how he believed that we were in for a hard landing with a much deeper low. And I argued that the amount of wealth that's been created in the world over the last 7, 10, 12 years is going to prevent some of that from happening unless there's some real crisis event. Uh, and the market again is flagging out up near these highs. I mean, look here, even though I have all of this data, might be really hard to see here. Let's come back over here, go back to SPY and look at this data. I mean, this is absolutely beautiful when you see this data setting up. Where is the SPY right now? Where is the SPY? It is struggling right now to get above this previous resistance area right here. I'm going to try to highlight it, bring it to front. And there is our key resistance area, 418 and a quarter. Okay, if we can get above that level, we're going to target this area on the SPY, maybe get up to this area, which would be, in my opinion, excessive. And then we're going to top out, just like I've drawn in this area here. And this is all from my research, knowing that we are still bullish. We're still looking for upward trending. Everybody's trying to short the market here. So unless you're willing to take the risk for another maybe 5, 6, 7%, please don't do it. We've got a topping pattern setting up between now and maybe the middle end of May. I'd say the 20th or 22nd. And then we're going to move into what I believe is a bearish downward trending pattern. First target is right here, potentially for support. Second support level is right down here. And I believe that at this point becomes very dangerous. We're going to play it by ear until we get down to this area. It could break downward as I've drawn here, or it could rebound and start to move higher. I've drawn this a little too deep here. I mean, ultimately, it could come down to this level, this support level. But I think it's going to hold up in this this circle area and try to find support. Okay. Ankur, I see you're here. I saw you joined earlier. Do you have any questions? Can you hear me okay? Reply in the chat section if you can for me. I've gone over quite a bit. I don't know if anybody has any questions right now. Oh, hold on. You can. Okay. Real quick question. Let me show you this. And what did you think of this new biasing system? Have you been following this at all? Oh, great. You're already a member. Fantastic. Yeah, these open webinars, Ankur, I'm going to, and hopefully I'm saying your name correctly, but I'm going to just discuss whatever people want until I get a decent following where we have a bunch of questions, and then that'll keep me busy. So right now I'm just basically, filling time trying to answer the most common questions. But I'm really loving this new SPY base trend indicator. I mean, it's intermarket. Let me explain a little bit. It's new. I just created a couple days ago. It is intermarket. It is capable of doing quite a bit. It does, like I said, this is 1 hour. You saw the gap here moved much higher. It does take some interpretation because it's intermarket. Let me explain some things. So because it's intermarket, we could have a dynamic where and it's intermarket global. So it's not just taking US markets into consideration. It's taking foreign markets, Asian markets, European markets, other markets into consideration. But what happens is generally, oh, okay, you went long. Good. That's outstanding. You caught a great move. Uh, anyway, so let me get back to it. So what it's designed to do is to tell us whether we have strength in the US markets compared to global markets, or whether we have weakness in oh, you're welcome. Yeah, I won't say how much you got, but I don't know these webinars. Maybe people could see the chat on screen. I have no idea. But again, that is a wonderful. If I have your permission, I'll just say what you've done, because that's the real value here. Ankur is a member. He's paying me a small amount every month, $55 or less every month, to have access to my service. He makes his own decisions. He listens to me. But he ultimately is responsible for taking his own trades and determining his own actions. That's the purpose of what I'm trying to do. is to give you the tools, give you the research, be kind of your voice in your ears telling you what to do and what I see without telling you, quote unquote, when to pull the trigger. And Encore's up $2,000 today on a very small position, which that's exactly what I want you to do. Honestly, Encore, if you could do that, 10, 20 times a month, you could be, making 20,000 dollars or more a month off of my research, which is $55 a month. I think that's a pretty good deal. And that's what I want. I want to try to help thousands of people do it. But the idea is right now, people will find me as they find me. But again, Encore, I'm loving this new bias trend. It takes, I'm using it. Let me explain how I'm kind of using it. So I'm using this level as a real confirmation. So hypothetically, where it goes bullish here up above this middle level, to me, that's real confirmation of any upward trending that's taking place here. These are short term. I've got this set down to very short term. So this is going to catch a nice little bump when it happens. So when this is bullish over here up above the zero level, when this is in an upward trend and this is in an upward trend, then I'm looking for the market, the SPY, to really resolve to the upside. And when it's in a downward trend like it was over here with this red, this is really a pullback. Now, I am still using the Fibonacci price structure. So this is a 1 hour chart. I am still using Fibonacci price theory and price structure into this. So remember, back over here, I had drawn a bunch of Fibonacci levels and gone over a whole bunch of high-low ranges, indicating where we were at for the Fibonacci price theory, indicating why we were still in a bullish trend is because we have failed to take out new lows. And that's why I still resolved my belief to the upside that we're going to hit this upside target. So as long as we're still longer term, daily, weekly, not generating any new Fibonacci price theory downward triggers, then I can come back over to this and say, okay, we're technically in an uptrend. We're looking for an uptrend. We may get some pullbacks like we saw here. This is a pullback, a bearish pullback here. So you can see here in the SPY, it got below this level, stayed below this level. This is a confirmation essentially that we're in a fairly deep downward trend. And remember, this is related to this. So the SPY should be pulling back from approximately this area all the way down to approximately this area or so, where it reverses back to the upside. Notice that it reversed back up right here. So I'll draw a vertical line. So when we get this big reversal here, telling us that it's moved to the upside, you can see it by this new line here. And again, this is the US markets performing better than global markets. And so what happens then is the SPY starts to rally upward. We don't have any real bullish confirmation yet, although we have bullish short-term bullish trending here. This is enough to tell me that we're having upward biasing and we're waiting for the longer term trigger to actually confirm and move higher. Once we get up into this mode here, this is where hypothetically, if I were to say, okay, we have confirmation comes right here. And this is an hourly chart. So remember, this is, we get good confirmation up here to the upside. Then we start to get some weakness here. Shorter term, we move bearish right here. Longer term, we move into red trending. So we're weakening our trend. And then here you can see on this bar here, we rotate downward. This is basically telling us our opportunity to go long in the SPY is over on this 1 hour basis. Now we would be looking for a pullback. We would be looking to try to buy into a bottom. Where would we get our bottom? We would start to look for support. So again, as we come down here, we establish a new low on this hourly chart. We'd be very cautious of it extending downward. We did extend downward. We based and bottom. We moved back over here to a basing bottoming. You can see this rotation short term back up into positive trending over here. We moved into green trending here, but we needed to be very cautious. So in other words, green trending here tells us that, okay, we should be looking for a bottom. Hold on one sec. will be looking for a bottom. And at this point, this is basically saying we need to look for a bottom. We need to look for a bottom. We need to look for a bottom. Buy into support. So you can see in this area, we had come down near these lows. We come back over here. We start getting on this big bar. We get these arrows indicating we need to start buying into support. Buying into support would be buying below this level here. So let me highlight here. So basically buying into or below this level as long as this stays green. So basically we would be buying in this area, buying in this area, buying in this area, expecting some sort of a base bottom. Now we would want for confirmation to see this move back to the upside and this move back above zero for confirmation. But this is really an indication that at this point, we're getting pretty solid trending confirmation of a bottom. And of course, we got this great big gap up pop. And again, this was, I believe, Monday. Great big gap up pop. This was the 5th. So that was Friday. And a huge rally on Friday, just absolutely blowing the doors off to the upside. So it's really cool how this is moving ahead of the market very well. Now, your question, do I take into account my research, CPI, PPI, FOMC? I find it amazing you were predicting these trends so many days in the future. No, my SPY cycle patterns, well, in regard to the totality of my research on core, I am not using any PPI, CPI, FOMC data. Now, I have modeled the Fed data going out to 2055 and beyond. And I can tell you what theoretically what the Fed should be doing, which is given the high inflation level, they're doing exactly what they need to do right now. But ultimately, the Fed will lower rates to below 2.5%. So understand that that is coming at some time in the future. And ultimately, 10, 15 years out in the future, Fed funds rate will be below 1%. I'll just give you that little hint. Okay. That's because unless something dramatic changes, my modeling system says the Fed is a little behind the curve right now, trying to catch up with the big bubble, as I highlighted back over here. I think it's here, wherever it was. Not here, not here, not here. It must be this one then. The big bubble. Oh yeah, it was the Dow Jones. So DJI. The big bubble took place. Okay, maybe it's not this one. I highlighted this whole thing on the Dow Jones earlier. Now I can't find it. It's not here. It's not here. Oh, here it is. So here's this big wealth bubble on core, and the Fed is migrating through a contraction period, which is the big, which is related to this massive wealth bubble and wealth resource that's been created. So right now, the Fed is doing what they need to do. The markets are going to digest, but like I keep telling everyone, we're into a fairly solid congestion phase, which may be very difficult going out into the next couple of years, but eventually we're going to end up in some kind of a rally bubble. The next big Fed induced rally bubble up over here, which will then start to peak out in 2027, 8, 9, 10. Sorry, 2027, 28, 29, or 2030, 31. It'll start to peak out over here, and then we have a deeper contraction. And this deeper contraction, as I mentioned, everybody, is in a minor case going to be about 30%, 36%, which is going to put us about here. I'll move this out of the way so you can see it. Back in this area, 33 to 36%, which is the top of the wealth bubble back over here, or possibly 62%, which will put us down in here, right in this area near the 2018 lows, December lows, or ultimately, and this is the real scary part, or ultimately the 2015 highs back down here, 68%. Now, what's interesting about this Encore is that this move here, this move here was a 53, roughly 60% downside move. This is essentially the same percentage point. Okay, so when we get down into this area, 53, 60, down into these deep lows, this is the same percentage point correction as we saw in 2008 to 2010. Ultimately, I don't know how deep this is going to go, but my initial reaction is here, roughly, or this midpoint area down here, roughly 55 to 62%. So down in this area, which will put us right back into these COVID lows, which is not, I mean, it's a pretty big drop, but it's not a catastrophe. Okay. I mean, in relative terms, yes, it's a catastrophe. So I've got 9 more minutes left to go. Do you have any other questions on core? And again, no, I do not use any fundamental data. Everything I do is based on either adaptive technical, adaptive cross market, intermarket analysis, cycle research, Fibonacci. I'm very big into Fibonacci, Gann, Tesla, and cycle. So, and there is no CPI data, PPI data, or anything else. All right, you're welcome, buddy. No problem. Okay, so real quickly, how long have you been following me? If you don't mind me asking. And what are your experiences so far, besides your comment that you find it amazing that I'm able to predict these trends so many days into the future? Very curious what you think. I hear a lot of great comments. In fact, the gentleman I spoke to earlier this week said the exact same thing. His exact words were, "You've made some incredible calls and they've come true." So I do like to think I'm providing a very good service for everyone. Um, but basically, I'm very interested in hearing from members to see what we have left. Look at this strength into the close. Oh my gosh. Let's come back over to the SPY. Just a huge rally. Let's come back to the hourly. Where's my hourly? Oops, don't have it here, have it here. So we'll go to 1 hour. Huge move, just absolutely crushed it. This was a great bottoming signal, but we need to see how it plays out. So, in fact, let's come over here. Hold on, guys, on the other side of my screen. We'll come here. We'll come to here, here, here. Oh, where's it down the bottom of my screen? I can't see it. So what do we have in terms of SPY cycle patterns? We have a massive crush pattern tomorrow. Okay, going to be very interesting. Crush pattern in congestion, bearish trending. This may change the trending, the short-term and long-term trending today. We are in a trend crush. Okay, then we have a major crush over the weekend, then we have a bottom setting up. So given where we're at right here with our upward trending, daily, weekly bullish trending into expanding, then congesting, and obviously yesterday was a congestion day. The Harami inside day didn't actually play out, but given our crush pattern for tomorrow, I really would be very cautious of a very big move, and then potentially setting up a bottom on Friday. Bottom, a trending bottom would mean the market would come down, attempt to establish some sort of a low as a base or a bottom, maybe a pre-existing low, maybe a new low, but basically it's going to be potentially some sort of a bottom creation structure. Now the 004 means that it is a unique pattern type from a regular a bottom pattern, meaning that it's fairly isolated compared to regular bottom type of patterns. But we're getting into this once we see how we went from explosive to expanding to congestion. This is a big breakaway trend and obviously into a bullish mode with the economic data coming in strong. So tomorrow with the big crush pattern means that we could see a big move. And based on my analysis, if we're in an upward trend, in a trending mode, in a crush pattern, I'm leading myself to think that it's going to attempt to move above the 418 level So potentially we could see some sort of a move from where we close up into here. That would be a 1.3 to, let's call it 1.5 to 2% upside potential move tomorrow. It could be just massive. Anyway, this is the move up to 421, 430, 431. And likely it's going to take place and start to be very toppy. Once we get above 421, 425, guys, like I said, my advice would be don't chase it, run protective stops. I'm telling anybody that'll listen to me that between now and roughly May 25th, you need to start protecting and hedging and preparing for that next down move. If the best advice I could give anybody that follows me is after May 16th, 17th, 18th, roughly, if you're still trading full allocation on anything, you're being foolish, in my opinion. Yeah, there could be some big moves, and yeah, you could catch a couple of lucky trades. But the reality is we move into a topping pattern. I believe that topping pattern is going to roll over by say June 5th to 10th, and it's going to start to move downward fairly aggressively. So if you're still trying to get long the market and trade the upside, I don't think you have a whole lot of opportunity left. Okay, Ankur, I really appreciate it. Come back. Let's do this again. Remember, I made changes in the website, so all of the member-only sessions are inside the expert growth membership area on the right side. I'm going to keep those out there. Uh, Good. Yeah, you're preparing for it. Like I said, prepare for the moves and try to time them efficiently. I'm giving you weeks and months notice ahead of these moves. So, and I will keep you updated when I see these things weaken. Right now, like I told you, the biasing system is still long. Everything is still long. The 421 level, really, in my opinion, once we get above 421, 425, if we get there, we still have yet to get there. That's when I will start to urge everyone to get very cautious. You can still chase the move up as long as it's going to go up, but you need to be very cautious. Okay, again, really appreciate it. I know you're learning the system. Everybody learns the system. Remember, my system is more about giving you critical data, input, and advice, and then you make the decision. I'm really not trying to tell you what to trade and how to trade. I'm trying to tell you what I see, what I expect, and what's coming, and then we'll see how it plays out. All right, everyone. Thank you very much. You're welcome, Encore. Have a great day as well. Talk to you guys later.